In 1637, a single flower bulb in the Netherlands cost more than a manor house. This wasn't a rare jewel or a precious metal, but a tulip, a simple, vibrant blossom elevated to an object of insane speculative frenzy. What began as a horticultural fascination morphed into the world's first documented economic bubble, a cautionary tale echoing through centuries. To understand tulip mania, we must first glimpse the Dutch Golden Age. The Netherlands, a burgeoning maritime power, was awash in new wealth from trade routes spanning the globe. Amsterdam, a bustling hub, became a center of commerce, art, and scientific discovery. Tulips, originally from Turkey, arrived in Europe in the late 16th century. Their exotic beauty and vibrant colors captivated the wealthy elite. They weren't just flowers, they were status symbols, a tangible display of affluence and refined taste. The most prized tulips were those with broken petals, exhibiting flame-like streaks of contrasting colors. This striking variegation, unknown at the time, was actually caused by a virus. Yet this imperfection made them extraordinarily valuable. As demand grew, so did prices. Initially, this was a logical progression. Rarity plus desirability equals value. But by the 1630s, the market began to disconnect from reality. People weren't buying flowers, they were buying the promise of future wealth. The market wasn't just for bulbs in the ground. A sophisticated futures market emerged. People traded paper tulips contracts promising delivery of bulbs after the harvest. This allowed anyone, regardless of whether they had land or even a single bulb, to participate. The frenzy became self-reinforcing. Prices rose because people believed they would continue to rise. Everyone, from wealthy merchants to humble chimney sweeps, wanted a piece of the action. Stories circulated of ordinary people becoming rich overnight. One particular bulb, the Semper Augustus, became legendary. Its distinctive crimson flares against a white background made it the most coveted. By 1636, a single Semper Augustus bulb was trading for 1,000 guilders, a sum equivalent to a skilled craftsman's annual salary. But the peak was yet to come. By February 1637, some rare bulbs were reportedly exchanging hands for the price of entire estates. Imagine a single flower, a perishable item, commanding more wealth than a fully furnished house in Amsterdam. It defied all rational valuation. The market was fueled by pure speculation, not intrinsic value. People took out mortgages, sold businesses, and invested their life savings. The fear of missing out, or FOMO, as we call it today, drove irrational decisions. However, like all bubbles, this one was unsustainable. The supply of tulips, though carefully managed, was ultimately finite but reproducible. The exponential price growth couldn't continue forever in a world of limited capital. The turning point arrived in Haarlem on February 3, 1637. At a routine bulb auction, for reasons still debated, no one bid. The expectation of ever-rising prices shattered instantly. A ripple of doubt became a wave of panic. Within days, prices plummeted. Those who had mortgaged their futures found their assets worthless. A bulb once worth a house now fetched less than a common onion. Fortunes evaporated overnight, leaving ruin in their wake. The economic fallout was significant, though perhaps not as catastrophic as some later accounts exaggerate. While many individuals faced financial ruin, the broader Dutch economy, robust and diversified, absorbed the shock. But the psychological impact was profound. The Dutch government tried to intervene, offering to honor contracts at lower prices, but it was too little, too late. Trust had vanished. The market had collapsed under the weight of its own irrational exuberance. Tulip mania serves as a stark warning about the dangers of speculative bubbles. It illustrated how human psychology, greed, fear, and the herd mentality can override fundamental economic principles. It showed that when an asset's price becomes entirely detached from its intrinsic value, driven solely by the expectation of greater fools paying more, a collapse is inevitable. The greater fool theory was born from this very moment. This wasn't the last time the world would see such a phenomenon. From the South Sea bubble in 18th century England to the dot-com bubble of the late 20th century, the pattern repeats. Each time, the asset changes, but the underlying human behavior remains eerily consistent. The story of tulip mania isn't just a historical footnote about flowers. It's a foundational lesson in financial literacy, a testament to the enduring power of irrational crowds and the fragility of markets built on hype rather than substance. Today, tulips are simply beautiful flowers enjoyed by millions. Their value is measured in aesthetic pleasure, not in the price of a house. The madness has passed, but the lesson endures. The Dutch tulip mania serves as a timeless reminder that while innovation and prosperity can drive genuine growth, unbridled speculation, fueled by the siren song of quick riches, often leads to inevitable destruction. It's a story that continues to resonate, urging us to question the underlying value of our investments and to be wary of any market where the price seems too good to be true and everyone suddenly becomes an expert. Explore another infamous financial downfall and the lessons we still haven't learned.